First off, thanks so much for coming out to our fifth community event, especially on probably the nicest night of the year so far.
So yeah, I think these two charts are a good illustration of why putting your money to work instead of putting it in a bank account can, yield dividends, so to speak. And of course, the great irony is that with investing, the younger you are, the more time you have on your side. Despite the fact that people tend to get into investing when they feel rich, when they're middle-aged. Actually, by that stage, they might have missed out on their best years, and that's time you can never get back. But why has that happened? Well, a few reasons. Big fees, obviously. Outdated tech is something that really bothers us. And also just the way that companies that traditionally offered investing speak to their customers, the kind of people they talk to, the way they talk, and how complicated they make it. And free trade fundamentally exists to change all that. We cut the fees, we cut the talk, and we don't market to exclusively the old and rich who we think are kind of comfortable with these ideas already. On that note, I think it's interesting to dive into kind of two myths around investing. And they're really propagated in our media, like through pretty much all the investing movies, in the newspaper. You always get the sense that investing is like for hardcore pros. Even stuff like The Big Short creates this image that you have to be really, really on it and really professionalized in order to invest. And then meanwhile, on the other end, you have a bunch of images coming through advertising, coming through trading firms, saying that investing is all about kind of making money in a fast-paced way, that it's fundamentally like gambling, and that you could expect to day-to-day take control of your money by making fast trades in and out. We really refute both of those myths. For us, the truth is that investing is work. It's not fun and games, but it's not necessarily super hard work. It can be as intense as making it your whole life and coming through company reports, or it can be simply something like life admin, like sorting out your mortgage, or even doing the recycling. Just a habit you do to make the most of your money. But a lot of people confront us, and we're also confronted with, as a company, the question of how do people actually get started with this work? And it's actually pretty simple, and we've broken it down into steps. And the first one, this is probably the most important for me, is stop procrastinating. And this is particularly personal because it was a year and a half that I went from thinking, wow, I should really invest. I don't know what I'm doing with X many pounds in my bank account just sitting there doing nothing, and actually having the confidence and courage and sense of security to go and do that. That was before Freetrade even existed, so I actually had to go through the rigmarole of using a legacy broker, which really didn't help. But yeah, if you're here tonight, it's clearly on your mind, and what I would say is don't let perfectionism or not knowing exactly what you want to do stop you, because that hesitation will really kill you once you start. Again, it's time you don't get back. The second point that you should look at when you kind of reach that stage where you want to invest is actually to know what you want to do with it. Investing is great, but it's best when it's actually focused on a goal. Buying a house, saving for retirement, probably two of the most common. Diving into a big pot of gold. Originally, Scrooge McDuck, fairly regular duck, but through diligence and care, he became the wealthy duck we all know today. And then the third step, once you've kind of got your goal and you know how long you are going to take to achieve it, is to estimate your time frame. Your time frame is really going to define a lot of how you invest. If you've only got a year before you want to go and buy a house or travel around the world or potentially quit your job, it's worth bearing in mind that investing might be something that's going to happen over a much longer term. So yeah, once you've got your goal, your time frame, giving yourself a bit of a kick up the butt, and you've got some savings going, then you can start to actually think, what am I going to invest in? Well, the first thing that we'd say is not in everything. The first question that people often ask us in our community when they're first getting into it is, okay, what do I buy? And they always focus maybe on one or two companies that they've had their eye on. And that's a great way to start, but it's really important to remember that when you're investing, you really don't want to have all of your eggs in one basket. Even the best made decision could go really awry, and by kind of sprinkling those decisions and your money across a lot of different potential sources of growth, you can save yourself a lot of pain and a lot of kind of thumping heartache when you wake up in the middle of the night, as anyone who invested in Bitcoin would probably attest to. So yeah, when you're looking to diversify, worth remembering there are lots of stocks out there, lots on Freetrade to kind of grab your eye, but there's also lots of other things, lots of other asset classes. Before I open up, can anyone name a few asset classes? Property, that's a really good one. Lots of people in the UK invested in property. Anyone else? Sorry? Financials, so you mean like bonds or the money markets? Okay, yeah, yeah, hedge funds and the money markets, both kind of slightly more expert asset classes, but yeah. So we've just kind of broken them down into the sort of the most vanilla ones, and stocks and equities, companies basically, public companies. Bonds, which are essentially loans that you either pay off to the government or that you deliver to a company, and they promise to pay you back along with some interest. Commodities, basically stuff you dig out of the earth, gold, oil, copper as well, and property, of course mentioned, everyone knows property, and funds. Funds are kind of a slightly unique asset class because they're kind of all the assets combined in one. Using a fund, you can invest in pretty much all of the other of these in a diversified way. So on Freetrade, our universe is really focused on funds, which can track a number of things, and individual stocks. It's really important to have a balance between your funds, which give you instant diversification, let you track just a whole universe of particular assets, and kind of conviction bets around a stock that you really believe in or a company that you think could outgrow the market over time. And just to illustrate that, pretty much all of these kind of huge, wide-ranging areas, there's a fund for investing in that, and there's a fund on Freetrade, which you can invest for free in that. Step two, it's really important, especially when you kind of go out to market and start to look at providers. Know what you're buying. This is especially kind of true in the context of the UK, where there are a lot of trading sites out there, there are a lot of investing sites out there, and sometimes they kind of blur into one. So this is an example of one of our competitors. I'm going to name the particular one because there's no need, but one of these is actually a stock and one of them is a trading instrument, and I defy pretty much everyone, including members of our own team, to tell the difference. One of them is highly leveraged and moves fast across the markets. One of them is a fairly standard stock and will just kind of grow as the company grows, and lose value if the company loses value. It's a really good illustration of the fact that what you could be buying when you invest with a provider that you're not too sure how they operate, you could be buying something that you have no idea how it works. Step three, this is really important. Keep your emotions in check. It's one of the hardest things to learn as an investor, and especially when, of course, you're investing your own money. There's a pretty famous anecdote about a really big investment manager in the 80s who was he had like multi-billion-pound positions in all these risky things, and one of his clients said, "How do you sleep at night?" And he replied, "Well, it's not my money. How do you sleep at night?" And yeah, it's a good indication of the fact when it's your money at risk, emotions can really come into play. It's one of the reasons why we don't do like kind of practice with fake money kind of accounts, because it really doesn't teach you anything. This quote here: "Success in investing doesn't correlate with IQ once you're above 125. Once you have ordinary intelligence, what you need is the temperament to control the urges to get other people into trouble investing." Any guesses as to who delivered those words of wisdom? Buffett, exactly. And yeah, it's completely true. I mean, Buffett, the world's greatest investor, also one of the world's most simple investors, and a lot of his intelligence is really just psychological and emotional, and being able to just resist his worst impulses and kind of know when he doesn't know what to do. So the two emotions that you're probably going to first confront when you get into investing, the first is greed. It's when you see something that promises you that you're going to do amazingly overnight, and you go into it and then get stung, and it kind of turns you off from investing for a long time. Yeah, no matter how kind of high the reward, it's never worth kind of single-handedly pursuing just that, because there have been so many bubbles through history, and you know, there's nothing that looks perfect at the time that can't eventually turn out to be you know, ultimately valueless. Equally, control your fear. As you can see on the US stock market graph that we had over 70 years, there were lots of bumps, lots of ups and downs. But obviously, we don't look at our portfolios over 70 years. We look at them day to day, and you can buy something, and the next day see that I don't know, Trump aims a rocket at someone, and the entire stock market has gone down 10%, and you think, why is my company that I believed in gone down 10%? It might not even been to do with the company, but it's really frightening to see that money that you were used to seeing stable in your bank account has now gone down. It's a really bad thing to look at those negative percentages and just instantly react by, I've got to get out of this. The stock market fluctuates over time, and controlling your fear and being able to live with that, one of the hardest and most important things that you can do when you first start investing. The fourth lesson, which I hope doesn't kind of conflict too much with us, because some say you're free trade. Why don't you advocate trading? We advocate investing rather than trading, and the name can be a little bit confusing. But there's a good reason for that. Trading is kind of all about the short term. It's driven by volatility. It's highly intense. You know, it'll grip a huge amount of your attention and time. In contrast, investing for the long term, it's ultimately kind of driven by value, and you need to have patience to see it pay off. And between the two of these, you might say, okay, well, they're different, but why is one worse than the other? And that's when we kind of tend to turn to sites that specialize in trading and look at the state that they often get their customers into. So this little sort of T's and C's at the bottom is something required by law to put on the bottom of every trader in trading products. It basically tells them how many of their customers have lost instruments trading on that provider, and it's kind of a constantly frightening statistic to see, and a really good indication of the fact that when you're trading, as an individual retail trader, most of the time the stats say that you're going to lose. You might be able to beat those odds, but then certainly not in your favor. The fifth point is really important. It's kind of appropriate once you've started to get going, you've made your first kind of influx into investing over the months. And that's to actually kind of measure what you're doing. Even if you get started, that's great, but you should kind of be optimizing, slightly improving over time. So look again, this is a passive investment in the US stock market since 2009, since the crash. And that's actually, that graph indicates it's gone up by 3x, like just a standard £100 in a very vanilla tracker of the 500 biggest US companies. So it's a good indication of the fact that you don't necessarily need to take the most kind of skillful, strategic, delicate approach with your portfolio, delicately crafting it, especially not if what you find when you come to measure it is that you could have done better doing something that required very little skill, that just required a passive investment in something that you could really easily understand. So yeah, when you come to measure your portfolio, basically, don't just judge it against have I done well or have I done badly, have I made money or not, but have I made money versus what I could have done with a much less sophisticated strategy. If you haven't, potentially you could look at maybe drawing back from some of the ego and doing something that's a little bit more basic. If you have made money over the long term, that's incredible, and yeah, maybe you should consider a career in investment management. The final step, which I just kind of wanted to reiterate, it's kind of a cop-out, but also I think it's worth re-emphasizing, is seriously stop procrastinating. Everyone around here who's only just got started or who hasn't got started at all, maybe you've downloaded the Freetrade app but you don't know what to do, I'd say take the first step, because from personal experience, every moment that you spent not investing once you heard about it, once you start, is going to pain you. So yeah, if you haven't downloaded the Freetrade app, obligatory call to action to do so.